Most option strategies have a duration of 30 to 60 days, but most day and swing traders like to be in and out of their trades much more quickly than that. I'm Seth Freiberg, the head trader of SMB Capital's options trading desk here in Manhattan, and we're asked all the time if there are ways to implement daily options income strategies. And the good news is that there are logical approaches to daily option strategies based on the unique nature of how options work. In this video, we'll show you an easy to implement example of just such a strategy. So if that sounds like something you'd like to learn about more, then stick around because I think you're going to find this interesting. Hi, I'm Seth Freiberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so for years, traders thought of option strategies as longer-term, multi-month trades, which are subject to the unpredictable nature of overnight risk and the sometimes large drawdowns that can take place on trades exposed to those risks. And that's because for years and years, options only expired once a month, usually on the third Friday of each month. But that evolved over the years so that originally weekly expirations were introduced, and ultimately in 2018, the options market started offering expirations on Mondays, Wednesdays, and Fridays of each week for a small number of indexes and equities. And so now it's possible to open and close a trade using SPX index options on the same day, and you can do so 3 times a week, which comes out to about 150 days a year. So suddenly what used to be something you could only do once a month, you can now do 3 times a week, which makes this a really viable way to trade for a living. And so the most notable of all these are the index options derived from the S&P 500 index, which are known as the SPX index options. And the strategy that I'd like to teach you today is implemented using SPX index options. Now, in order to explain to you how this one-day strategy works, we have to make sure that you're all familiar with how index options work. So we're going to do a really quick review of them. And those of you who are familiar with how they work, just hang in there. This is going to be really quick, and then we'll jump back in to teach you how you trade this particular setup. All right, so the best way to understand index options is to think of them as bets. What are known as a call option is a bet that pays off if an index closes above what's known as the strike price of the option on the day that the option expires. If the index does close above that price on expiration day, then the call buyer gets $100 per point that the market closes above that call strike price. A put option is the exact opposite. It pays off if the market closes below the strike price of that put option. Again, $100 per point that the market closes below the strike price of the put. So for example, if an index closes at 40.32, then the 4,000 call would pay $3,200, as you can see from the calculation, because the index closed 32 points above the strike price of the call, which is 4,000. However, the 40.75 call would expire worthless, as the index didn't close above 40.75. So the call seller just pockets the premium, and the puts are just the opposite. If the market closed at 40.32, then the 40.75 put would be worth $4,300 because the market closed 43 points below the put strike price of 40.75. But the 4,000 puts would expire worthless because the market didn't close below the 4,000 strike price. So now with that as background, let's take a look back at a recent Friday when the SPX index was trading at 44.4280, about 15 minutes after the opening bell. So now, if you look at this options chain, you'll see that there's a highlighted column known as the options delta. And options delta is a way to predict the price movement of an SPX option based upon the price movements of the SPX index itself. But the delta has also been shown to predict statistically the chances of an option expiring in the money, which means that the closing price of the index on the day that the option expires requires the one who sold the option to the option buyer to pony up and pay cash to the option owner, like we just discussed. And so what some traders like to do, which we're illustrating through this options trade that you're seeing right now, is that they like to select a call option, which is pretty far above the market, where there's only about a 10% chance of the market closing above that strike price. And similarly, they go pretty far below the market and sell a put at a price where there's only about a 10% chance of the market closing below that option. And then they go ahead and buy a call option 10 points above the one they sold and simultaneously go 10 points below the put they sold, and they buy a put option 10 points below that. And this can and is easily done through what's known as a complex order ticket, which every major broker that offers options trading provides. So in this case specifically, with the market trading at 4,442, a trader could have gone about 32 points above the market to the 44.75 call strike price, which you'll note has a delta of 11.7, and sold 4 of those options for $1.05. And then, like we said, he'd go 10 points higher and buy 4 of those 44.85 calls for 51 cents, and those are for protection. Then he'd simultaneously go down about the same amount, about 37 points below the market, and he'll find the 44.05 put, which has a delta of 9.2, and he'll sell 4 of those for $2.14. And then for protection, he'd move down 10 more points to the 43.95 strike and buy 4 of those for $1.18. And so this whole structure put together is what options traders refer to as an iron condor, where the short call and the short put are both located at approximately 10 deltas, or as close as you can get to that. And he did this intentionally because he wanted there to be close to a 90% chance that the market never reached the short call strike. And he also wanted there to be about a 90% chance that the market would never reach the short put strike. And you'll see in a minute exactly why he did set it up with those odds. Now, before we move on and explain how this one-day iron condor trade works, and more importantly, why, if you want to learn 3 option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, or the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or index trade even if you're outright wrong on the direction, then click the link that should be appearing now at the top right corner of your screen. That's going to open up a free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this, so pause the video, sign up now, and then resume watching. Now let's drill down into what we've just done here by providing you with a cash flow breakdown of what just happened when we entered into the iron condor trade. So starting with the short calls, 32 points above the market up at that 44.75 strike. Well, we sold that one for $1.05, but that pays off $100 per point above 44.75. So that price is multiplied by 100, and we sold 4 of those. So that comes to $420. But then we turn around and bought the 44.85s for 51 cents. So that's actually a cost of $204. And we received $8.56 for selling the 4 44.05 puts for $2.14, and then turned around and protected ourselves by buying the 43.95 puts for a total cost of $472. So when you net it all down, the initial cash inflow from the iron condor would have been $600, and your broker would have required you to have at least $3,400 in your account to execute this trade, which is the worst case scenario on the trade, incidentally. Okay, so now let's move forward to the end of the day when the options expire. And as you can see, the SPX index closed at 44.55 that day, which, as you can see, is well below the calls at 44.75 and 44.85, and above the puts at 44.05 and 43.95. And the fact that it closed between all of the options shouldn't be very surprising. Why? Because as we said earlier, the trade started off with only a 10% chance that the short calls at 44.75 would close in the money. In other words, the options market was predicting that there was a 90% chance that the index would close below 44.75, which it did at 44.55. And the same goes for the 44.05 short puts. Those were set up 37 points below the market, and at that point, the options market estimated that there's only a 10% chance of the market closing below 44.05. And so it should not be surprising that the market didn't hit either of those levels, but just ended up in between, which is what it did. So then what are the implications for our trade? Well, let's think about it. If we start out with the recognition that we received $600 at the outset of the trade, and then we look at the individual options that we traded, we will see that both the short and long calls, which both expired above the market closing price, and the two put positions which both expired below the market price, we realized that none of those options that we entered into had any value at all at expiration. Why? Because the calls were all above the closing price and therefore had no settlement value. They just went out worthless. The call sellers weren't obligated to pay anything, and the call buyers weren't entitled to anything. The same is true on the put side, where the market closed above both of them, and so neither of those contracts were activated either, which therefore means that all of them expired worthless, and so you're left with nothing more or less than the $600 you collected at the outset of the trade. That's your money, you get to keep it, which means that your return, based on your broker requirement of $3,400, would have been 17.6% in a day. That's way more than the market goes up on the average in a year, just to give you some perspective. So what I'd like you to take away from today's video is the fact that there are ways of setting up high probability one-day trades using index options, and you don't have to wait 1 month between trades. There are 3 trading days each week these days for the SPX index options and other instruments, and so it's really viable to have a trading business based on index option strategies like iron condors if you have a little bit of training and understanding of the nuances of these trades. Professional options traders have the knowledge to develop strategies like these and hone and develop them with firm backing if the trader's intelligent and disciplined and puts the work in to establish viable one-day strategies that stand the test of time. Now, just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can head over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now before you miss it, and please don't forget to click on the subscribe button right now so you won't miss any of the free trading videos that we're posting constantly on our channel to help you to improve your game as a trader.